Welcome back, best ever listeners, to the Horizon Podcast. I'm Chang, and I've been active in commercial real estate investing most of my life. And since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, I must mention, as I do each week, that I am doing this podcast independently, and what I say on this show doesn't reflect the opinion or positions of Marcus & Millichap. So, I've got a story to tell this week. Over the last couple weeks, I've been working on a few different projects, and as I've been delving into each one, they kind of started to blend together. One project was focusing on investor activity and the flow of capital into commercial real estate. Another project was tied to cap rates and the variance in cap rates between different markets around the country. And the third project was tied to the performance of commercial real estate, the fundamentals, basically occupancy rates and rent growth. Now, I was looking at several different types of property to start with: apartments, multi-tenant retail, office buildings, industrial properties. And each of these projects was independent of the others. I was doing them for different people. And as I was noodling each of these different projects, they all started to blend together in my brain. And then I realized that the three projects I was digging into were actually all related. They're all tied to each other. And that was my epiphany. And that's what I'm going to share today. So in general, I think that the commercial real estate investment market is relatively efficient. I mean, it's at least a lot more efficient today than it ever has been. There's more information available. It's easier to trade. It's easier for people who aren't commercial real estate experts to get into the market. There's more liquidity. There's more transparency. But as I was thinking about things, I came to the conclusion that commercial real estate investment is actually still tremendously inefficient. So, yeah, it's easier to get into, and there's a lot more tools available, but the market itself is very inefficient, and the way capital flows is actually not optimized at all. So, although I had drilled into several different property types as I worked on these projects, for this podcast, I am really going to just focus on apartments. For one, I think most of you listeners are more focused on apartment investments, but on top of that, the apartment data demonstrates my key points more clearly than the office or retail or industrial data. Those have been more significantly influenced by other forces like the pandemic, supply chain disruptions, and the emergence of e-commerce, for example. So the data is just a little dirtier and harder to follow. So I'm really just going to focus in on apartment trends for this, but these things that I figured out do translate to other property types, just not quite as cleanly. So anyway, I was looking at apartment revenue growth, and specifically I was looking at Chicago rent growth because Chicago has had the strongest rent growth on average in the country over the last year. And I've been to Chicago a few times in the last couple months, and something that's been nagging at the back of my mind has been the fact that the cap rates in the Chicago area have been running higher than a lot of markets around the country. That was one of the other projects that I had. Basically, a friend of mine was saying that the average cap rates I'm reporting in my research is too high, that the national average cap rate for apartments of 6%, which I have validated in numerous ways, but my friend thinks that it's about 50 basis points too high, at least compared to what he's encountering with the people he's been talking to. So, I was looking at this, and the average cap rate in the Chicagoland area is about 7%. Now, it varies, right? Class A, Class C, great location, secondary location. I'm talking about the metro average. The metro average for the deals that have been trading over the last year, the average was about 7% cap rate. And I validated that with several people in the local market, and I've run the data and the analytics in MSCI or RCA as it used to be known, as well as CoStar. So here's the burning question that was in my mind. Why are Chicago apartments trading at a 100 basis point discount compared to the national market when it has the strongest rent growth in the country? And of course, I sat down and I said, well, okay, there's a few reasons that could be. There's more policy risk, right? The probability that they'll add rent control or have, enforce rent control in Chicago is higher than on most of the markets around the country. It is a renter friendly market. And the growth outlook isn't that great. I mean, it's all right, but it's not, when you list out the top growth markets in the country, Chicago's not on the list. Also the taxes especially in certain parts of Chicago, tend to be higher than most other states and most other metros. And maybe the rent growth over the last year has been an anomaly. Maybe this is just a freak accident where every place else has fallen and Chicago has surged ahead a little bit. So I started checking into some of these things, especially the rent growth, and I looked at the revenue growth, which factors in the occupancy change as well with the rent growth. So a change in occupancy and the change in rents. And I looked back since the first quarter of 2020. Just prior to the pandemic, before we started to get all the bounciness and what's happened with the interest rates and inflation and so on. And so I looked back 5 years, and guess what? Well, it's not an anomaly. Chicago did pretty well over the 5-year span. The 5-year revenue growth for Chicago came in at 34.3%. Now, it's not the best in the country, but it's also not the worst. It beat the national average of 26.3%. And of the 50 markets I generally track, Chicago came in 18th overall, based on that 5-year span. How much has revenue gone up? So that's pretty good. That's pretty good. Really, actually, that's better than I thought it would be. And then I thought, well, where are cap rates lower than the national average? Again, my friend was saying, hey, the average should be somewhere around 5.5%. And so I looked around and I said, okay, where have you been hanging out? And Los Angeles has a cap rates around 5%. Salt Lake City, 5.3%. Austin and Charlotte, around 5.4%. Denver and Phoenix, 5.5%. Dallas, 5.6%. So basically, the highly sought after markets around the country, at least as of a couple years ago and probably still today, have lower cap rates. No surprise there. Somewhere in the mid 5% range, give or take. And so when I looked at the revenue growth for those markets that have the lower cap rates, basically, they underperformed. They had less revenue growth in the last 5 years than Chicago. In fact, only Charlotte and Salt Lake City even beat the national average. Now, if you go back further, comparing the rent growth since, say, 2011, just after the global financial crisis, kind of things were settling down and getting moving again in 2011, most of these hot markets did beat Chicago over the long term. Over that 14-year span, they outperformed, but not by that much. It varied from market to market, but, the one that I really focused in on at this point was Dallas-Fort Worth. The populations are comparable. The apartment inventory is comparable. In general, they have some similarities. right? It's better than comparing it to Los Angeles or something like that. So, and also Dallas Fort Worth is one of the hottest real estate markets in the country. It has been for the last 3-4 years. And probably, arguably, it was one of the hottest markets going back for the last 10 years. So, in that 14-year span, the revenue in Chicago is up by 95.3%, while in Dallas-Fort Worth, it's up 99.1%. So Dallas edges it out, is a little bit better. But since 2011, the cap rates in Chicago have gone from 7.5% to 7%, while the cap rates in Dallas-Fort Worth have gone from 7.5% to 5.6%. There's a big difference. Chicago is now 7, Dallas-Fort Worth is 5.6, and it's actually up a little bit compared to where it was a couple years ago. So investors in Dallas-Fort Worth have done way better in terms of appreciation, with the average price per unit climbing from about $55,000 in 2011 to about $175,000 in 2025. And you can compare that to Chicago, which increased from $107,000 per unit back in 2011 to the current $180,000 per door. So basically, Chicago and Dallas-Fort Worth, the price per unit is comparable. $175,000 in Dallas-Fort Worth, $180,000 in Chicago. But 14 years ago, Chicago prices were about double Dallas's prices. So big difference in terms of appreciation. But the thing is that it does explain the variance to a degree, but when you go out and survey investors, they invariably say that their top goal in commercial real estate investment is cash flow, not appreciation. They want cash flow. They want to generate positive yields year by year, and they view appreciation as the gravy on top most of the time. That's the average investor. That's the majority. I think it was about 70% said that cash flow was their top objective. Whereas, appreciation was like 20%, and other things like, tax, benefits was a small percentage. And there are a few other factors, but basically cash flow was king. And so it's just kind of funny to me that, you have Dallas on one hand, which has appreciated tremendously, drawing so much more capital than Chicago. If you look at the capital flow and you go back to 2011, the total apartment sales volume in Chicago was about $2.2 billion. And in 2021, the peak of the market, Chicago's total dollar volume was about $5.4 billion. And in the last 12 months through the first quarter of this year, the total was about $5.3 billion. You compare that with Dallas, though. Back in 2011, the total dollar volume was $2.7 billion. Basically, that's comparable to Chicago, 2.2 in Chicago, 2.7 in Dallas. But in 2021, the dollar volume in Dallas-Fort Worth was about $25 billion. So that's 4.5 times the volume of Chicago. And in the last 12 months, the dollar volume in Dallas has been about $12 billion. That's more than double the sales volume of multifamily in Chicago. So I thought that was crazy, and fascinating as well. So, why, where does this take us? And it drove a few conclusions already for me. First, the commercial real estate market is not as efficient as I had originally believed. The capital flows they don't really actually make that much sense if you believe that most investors are seeking cash flow. So there's something else going on there. And second, and this is tied to that first conclusion, the capital flows are in many ways driven by this. It's almost like a herd mentality. And I've heard a lot of people say this, commercial real estate, especially institutions, are like a giant herd. And they're always moving to the same places at the same time. Now, I'm not sure if that's because the people making the decisions, the investors in the institutions and the private investors, quite frankly, especially like the syndicators, I don't know whether they're following each other to the markets, or what I think is more likely, the investors are seeing the same information. There's more information available and they're all seeing the same stuff. And they're taking action in the same way. So they all see the same information and they all come to the same conclusion and they end up at the same destination and they're all competing for the same deals. And then my third conclusion is that over time, the fundamentals in the various markets have a tendency to self-correct to a degree. And by that, I think the best way to explain this idea of self-correcting, as well as some of these other points, is again through an example and going back to that Chicago versus Dallas comparison. I look at the markets and I think, okay, Chicago. What do I think about when I think of Chicago? And basically, it's a market that's been plodding along. It hasn't been exceptional. It hasn't really stood out. It's not the market that you see in all of the real estate media where everybody's talking about it. You don't see all of the investors saying, hey, I'm going to go invest in Chicago. You hear them say all the time, hey, I'm going to go invest in Dallas-Fort Worth. Dallas-Fort Worth is a hot market. So Chicago, over the last 14 years, has added about 500,000 jobs. The population has grown by less than 100,000 people. The population of young adults between the ages of 20 and 34, which is a prime renter cohort for multifamily, that demographic, the population between 20 and 34, has actually been shrinking in Chicago. The gross metropolitan product, basically the economy of Chicago, has grown by about 78% over those 14 years. And the number of Fortune 500 companies headquartered in Chicago has grown from about 8 in 2011 to about 15 currently. So it's not good. It's not bad, right? It's not like some of the markets where you're losing Fortune 500 companies. You're losing jobs, you're losing population. It's keeping the head above the water, but it's not by any stretch one of the best of the best. Now you flip it over and you look at Dallas-Fort Worth, and they've been a national leader in several key growth sectors. The metro has added nearly 1.4 million jobs. That's 2.5 times as many as Chicago. The population has grown by more than 2 million people. That's 27 times as many as Chicago, right? The young adult population has increased by 425,000. The gross metropolitan product has grown by 136%, which is close to doubling Chicago's economic growth, and the number of Fortune 500 companies headquartered in Dallas-Fort Worth has increased from 19 to 21. So there's 21 in Dallas-Fort Worth. There's 15 in Chicago. So Dallas has experienced way more growth than Chicago, and that has captured the attention of investors. Basically, they're looking around the country. Investors have been looking around and saying, well, where should I put my money? And they say, well, let's go to Dallas. It has the best growth. There's a lot of apartments there. There's opportunity. The rents have been growing. And, it gets this positive momentum. In fact, the Marcus and Millichap team, my team, has ranked Dallas towards the top of the stack for the last couple of years in our multifamily investment outlook. Because we're looking at the same data too. Look, you have a ton of growth, and that's really positive for commercial real estate in general. But over the last 14 years, the total apartment inventory in Chicago has increased by 88,000 units. That's about 13% inventory growth. 13% inventory growth over 14 years. Comparatively, the inventory in Dallas-Fort Worth has increased by 303,000 units. That's a whopping 45% inventory growth. So even though Dallas has had explosive economic growth, population growth, job creation, they've also been adding a lot more housing units. And, meanwhile, Chicago has had relatively modest growth, but their housing inventory hasn't increased that much either. So the apartment fundamentals in Chicago have actually outperformed Dallas-Fort Worth, the Dallas-Fort Worth apartment market, except for one thing, and that's property values. And those values are tied actually to the capital pursuing assets in Dallas-Fort Worth compared to Chicago. Basically, there's so much more capital going there. It has driven down those cap rates far more in Dallas than you see in Chicago. And as a result, the appreciation has been much stronger. And the massive economic growth is the force that's been drawing that capital to the metro. But the market fundamentals have basically self-corrected through development. So the fundamentals have not done as well in Dallas-Fort Worth as they have in Chicago because the development has outpaced that growth rate. Basically, it's held the market in basically it's doing better than treading water. It's gaining ground, but just not as fast as it would if they had much less development. So the fundamentals, the economic drivers that are so attractive to the investors has also been very attractive to developers. Plus, it is very easy to develop in Dallas, or I should say comparatively easy to develop in Dallas relative to markets in California or Illinois or New York, the Northeast in general. So it has attracted a lot of development capital, and that has reduced the momentum of the fundamentals in the market. So in a way, it's been self-correcting. So the market fundamentals have basically self-corrected through development, but the capital has kept chasing the deals and drove significant cap rate compression and price gains. And that brings me around to the investment strategies. As an investor, are you looking for appreciation or are you looking for cash flow? If you're looking for appreciation, then really the strategy is different. You're not looking at the fundamentals. You're looking at the economic drivers and the things that are going to draw the attention of the institutional capital, which is what really moves the market even more than the private investors. Even though private investors do more deals, the big money is the institution. They come in and they do these massive portfolios, which really drive the market. So you're really playing a bit of a guessing game, and you're actually trying to predict where the institutions are going to place their bets. And historically speaking, during times of uncertainty, institutional capital tends to flow to supply-constrained primary markets, the major metros with durable performance trends like Boston, New York, the Bay Area, LA, and so on. That's where it's traditionally gone. We saw that happen in the financial crisis. And we saw that to a lesser degree following, as we're going through the heat of the pandemic. But that's the safety play. During uncertainty, the capital flows to a safer investment that has historically been supply-constrained primary markets. So, for whatever good that does you, that's the traditional place where the institutional capital will land. So if that's your strategy, if you're looking for the appreciation, if you can beat them to the punch, get into a market before the institutional money goes there, then the market gets run up and then you can sell and you have your appreciation. But if you're pursuing cash flow, you're probably better off steering clear of the high growth markets, especially the ones where it's relatively easy to develop. Now I'll add in here that the current development cycle is winding down, and a lot of the policies that are being put in place at the national level will limit construction for several years. So the self-regulating pattern of commercial real estate may be stymied by the tariffs, and their impact on construction materials, as well as how immigration policy is affecting the availability of construction labor. So I guess that the self-correcting nature of this business, and it usually takes years, but the self-correcting nature may be stymied for a while by those forces that are changing the ability to add new supply. So it could be different this time. Nonetheless, if you look at a market like Cincinnati, right? Nobody really looks at Cincinnati, but Cincinnati, you may see that the average cap rate in that metro is 7%, and it had the 5th strongest revenue growth over the last 5 years. It's kind of a compelling idea, huh? Cleveland had an average cap rate of 7.5%. It had the 14th strongest revenue growth over the last 5 years. It beat Chicago. The average cap rate in Milwaukee is 7.4%, and that market had the 16th strongest revenue growth. It also beat Chicago. Chicago came in number 18. So you get where I'm going here. If you're a cash flow investor, there's a lot of good options out there still. You can have positive leverage. You can generate a strong yield and generate cash flow. But what you're not going to get is appreciation, right? You buy it, you hold it for 5 years, you sell it for a little bit more than you bought it for. You didn't make any appreciation, but you had cash flow over that span. These markets aren't that sexy and they don't have that much appreciation, but they do generate healthy cash flow. And if you go to tertiary markets across that region, they may do even better. You go to some outlying areas across the upper Midwest, you could get even higher cap rates. Now, you'll want to pay very close attention to the supply and demand fundamentals, what's happening with rent growth, what's happening with vacancy rates. But the point is that there's a lot of opportunities to invest to generate cash flow, even today with the elevated interest rates. So if you can figure out how to get a couple steps ahead of the institutions, and the herd that moves with them, who knows? Maybe you could double up. Maybe you can get into a market where you have that great cash flow, the higher yield, and that those institutions may come in later and generate the appreciation. But that would be the home run, and that's going to be tough to nail because these things tend not to go the same direction at the same time. So anyway, there you go. Best ever listeners. Thank you so much for listening to the things that have been on my mind lately and the projects that I've been taking apart and trying to put together to provide some insights to some people that I'm working with. I want to thank all of you for joining the Horizon podcast today. I will be back next Sunday and every Sunday with real estate insights to help you understand what's really going on in commercial real estate. So I'll see you next week. And as always, keep your eyes on the horizon.